Hello and welcome to the SB News Podcast. In this podcast, we will delve into the foundational aspects of the economy and analyze their implications. Please note that any opinions shared here are intended solely for informational purposes and should not be construed as investment advice. The Reserve Bank of Australia, RBA, unveiled key insights from its recent monetary policy meeting. During this session, RBA members deliberated over the global economy. Notably, they highlight that inflation rates decline across most advanced economies and exceeded expectations in certain cases. This trend is attributed primarily to lower energy prices over the past year. However, despite this dip, the core inflation rate, excluding volatile factors, remains above central banks' desired thresholds, displaying signs of persistence. While improvements is noted in the job market, tight conditions persist, and unemployment rates remain remarkably low. Moreover, RBA members observe rapid wage growth, exceeding the preferences of many central banks. As a potential solution, they suggest slower wage growth might be necessary to achieve the desired inflation target. Notably, several central banks in advanced economies maintain optimism that inflation will align with their objectives by the conclusion of 2025. In advanced economies, economic growth decelerated due to stringent monetary policies and escalating living costs. However, this slowdown is less significant than initially projected. Although the manufacturing sector faces previous setbacks, the services sector demonstrated resilience. Following a surge in spending after the pandemic in the United States and Canada, growth rates recently taper across various advanced economies. Encouragingly, RBA members identify emerging signs of increased real disposable incomes and overall wealth among households. This trend is attributed to decreasing inflation and stabilization or even growth in housing prices in select countries. RBA members assess the Chinese economy, Australia's key trading partner, which faces a lowered outlook for 2023 amid considerable uncertainty. The trajectory of China's economy depends on the recovery of household spending and the effectiveness of policies, particularly within the property sector. While indications point towards increased government support for the property market, the extent of this shift remains unclear. Notably, iron ore prices surged due to anticipated property sector support, while thermal coal prices fell due to weakened demand from Chinese industries. Moreover, members highlight that growth among Australia's significant trading partners is anticipated to fall short of May's projections of around 3.25% in 2023 and 3% in 2024. This significant deviation from pre-pandemic growth norms stems partly from evolving perceptions of China's future prospects. RBA members acknowledge inherent uncertainties within this outlook. They consider the possibility of advanced economies requiring further policy tightening in the face of persistently high inflation. Conversely, recent economic data, particularly from North America, presents unexpectedly favorable trends, potentially enhancing China's economic outlook. Shifting attention to the domestic economy, RBA members note consumer price inflation eased more than projected in the June quarter, sustaining its decline from the 2022 peak. However, inflation remains elevated and broad-based. The June quarter witnessed headline inflation at 0.9% in seasonally adjusted terms and 6% on a year-ended basis. Goods price inflation, especially for consumer durables, eased more than expected, in line with global cost pressures waning and domestic demand growth slowing. Progress in reducing inflation across goods categories remain uneven, with grocery prices, excluding fruits and vegetables, remain high. Similarly, service price inflation, particularly for market services, persists at elevated levels. Rent inflation accelerated, reaching an annualized rate of approximately 10% in the June quarter. Looking ahead, economic growth projection fell short of its typical trend in 2023 due to cost of living pressures and higher interest rates impacting demand. Nonetheless, output growth is anticipated gradual rise over forecast period, driven by alleviation of these challenges and upturn in household wealth due to housing market improvements. Year-on-year GDP growth is expected to bottom out at 1% by late 2023, progressively reaching around 2.25% by end of 2025. Near-term outlook appears more subdued than May, with GDP per capita registering a decline in March quarter. Regarding policy decisions, RBA members recognize recent data indicate economy followed desired path of inflation returning to target, accompanied by ongoing employment and economic growth. These observations align with revised central forecasts by staff. Nonetheless, potential risks, both high and low sides of forecasts, persist, including plausible scenarios where inflation's return to target takes longer than acceptable. Case for raising cash rate premises on risk of inflation proving more persistent than presently forecasted. Members note that in such event, raising cash rate significantly might be required to bring inflation back to target. This, however, could jeopardize prior employment gains. Members believe raising cash rate during this meeting could help mitigate such undesirable scenario. Furthermore, they observe staff's forecasts already factor in further cash rate increase. Notably, despite relatively high inflation in Australia, cash rate remains lower than policy rates in other countries. Lastly, resurgence in housing price growth suggests financial conditions are less restrictive than initially assessed. Conversely, argument for keeping cash rate unchanged at this meeting centered on substantial monetary tightening that already occurred. Consumption has already decelerated, preliminary indications of labor market turning point is emerging, and inflation is trending positively. These favorable trends, coupled with forecasts, indicate credible path toward achieving inflation target without necessitating cash rate change. In summation, members collectively concur stronger case exists for maintaining cash rate at current level for this meeting. Thank you for tuning in to the SB News Podcast. Please subscribe, like, and download our podcast. Your support greatly assists us in delivering further content of this nature to your attention.